After their March meeting, the Federal Reserve hiked the short-term interest rate by 0.25%. Before the events of the previous 2 weeks, that included the second and the third largest bank failures in U.S. history, bank runs on Silicon Valley Bank and Signature Bank, it was widely anticipated that the Fed would raise the rate by 0.5 point. But in their release statement, Federal Reserve policymakers indicated that this may be the last rate increase, as the committee seeks to achieve maximum employment and inflation at the rate of 2% over the longer run. In the light of banking system troubles and the still elevated inflation, Fed Chairman Powell said that it is too soon to determine the extent of these effects and therefore too soon to tell how monetary policy should respond. As a result, we no longer state that we anticipate that ongoing increases will be appropriate to quell the inflation. Instead, we now anticipate that some additional policy firming may be appropriate. Market volatility continued as everyone tried to read the mixed signals from the regulators. In her testimony before a Senate committee on Wednesday, Treasury Secretary Janet Yellen said that her department wasn't considering expanding Federal Deposit Insurance Corporation guarantees to all bank deposits, and that it wasn't the appropriate time yet to reconsider the $250,000 cap. But just a day earlier, on Tuesday, Yellen said that the government could backstop First Republic Bank deposits over $250,000. She also said in her speech to the American Bankers Association that the steps we took were not focused on aiding specific bank or classes of banks. Our intervention was necessary to protect the broader U.S. banking system, and similar actions could be warranted if smaller institutions suffer deposit runs that pose the risk of contagion. These earlier comments were perceived as the regulator's guarantee of all bank deposits, regardless of size, similar to their guarantee of the billions of dollars in deposits in Silicon Valley and Signature banks. As a result of these developments, all experts agree that we will experience further credit tightening across the economy, and credit will greatly affect housing affordability. It is double trouble for the Bay Area, as higher mortgage interest rates will amplify already high housing prices and limited supply of homes for sale. If you are thinking about buying a home this year, this video will help you understand economic forces affecting the housing market. And if you are ready to discuss your home buying plans and get a professional opinion about your situation, follow the link in the description of this video and connect with us. It will take only 30 to 45 minutes to develop a custom home search strategy and outline the first necessary steps. Now let's get back to the supply of homes. Since the beginning of the year, we've experienced an unprecedented decline in the number of homes for sale. The number of new listings in January and February dropped by 35% compared to the same time of last year. With the limited supply of homes, home prices started growing again this year. March median home sale price in Santa Clara and San Mateo counties increased by 7.3% compared to the beginning of the year. There are two major factors affecting the inventory. First, the economic uncertainty. People are staying put and don't move when they are not sure about their jobs, their investments, their future. Second factor is the mortgage interest rate lock. Most homeowners were able to purchase their homes or refinance at historically low rates in 2020 and 2021. These homeowners are not willing to sell their existing homes financed at around 3% interest rate just to buy a new house at 6.5% rate. They would compromise on the living conditions or remodel their homes instead of putting them on the market. Another factor in housing affordability is the cost of money, the mortgage interest rates. And the mortgage rates went on a roller coaster this year. According to the Freddie Mac Weekly Mortgage Rate Survey, the interest rate started the year at about 6.5%. Then they dropped to 6.1% by the beginning of February, just to go up to 6.75% the week ending March 9th. And while the difference in monthly payments for the median home in the area increased by more than $2,300, between the 3% rate and 6.5% mortgage rate. There are still enough people in the area who can afford it, who can absorb available inventory. Most lenders understand the challenges today homebuyers face and launched a number of new programs helping with affordability. They include rate buy-downs, first-time homebuyer programs, as well as more favorable interest rates for the buyers who can put higher than minimum down payments. Check my recent discussions with my favorite mortgage broker, Sue Baker Derrickson. Links in the description. This is Michael Tallis with the Tallis team. With major developments happening daily, if not hourly, I will stay away from predicting the next housing market move. I will continue, however, to monitor and report on all the latest trends. If you found this video useful, support us by clicking on the like button, subscribe to this channel, and hit the notification bell so you won't miss any of our future videos. Till next time.